In a world just overflowing with data, the real challenge isn't finding information, is it?
Not at all. It's everywhere.
Exactly. It's figuring out what actually matters and like understanding the deeper stuff. How do you cut through all that noise
Hmm.
and grab those, surprising facts and essential insights, the things that help you feel truly well informed?
That's the million-dollar question.
Well, that's precisely our mission here at the Deep Dive. Think of this as your shortcut to understanding a really groundbreaking investment philosophy, one that still shapes how top investors think today.
It's incredibly relevant still.
It is. So today, we're embarking on an in-depth exploration of the enduring wisdom of Philip Fisher, a true titan of investing.
Absolutely. A legend.
And his seminal work, Common Stocks and Uncommon Profits, first published way back in 1958.
1958.
And it's still profound. So our goal for this deep dive is to unpack the core ideas from excerpts of Fisher's Uncommon Profits, Principles for Growth Investing. By the end, you'll have the key nuggets, we hope, for identifying those truly exceptional businesses, the ones built for long-term success.
The ones everyone's looking for.
Exactly. So settle in, because Fisher's approach, it wasn't just about crunching numbers, was it?
No, not at all. It was much deeper.
It was about a profound understanding of what makes a company truly great. And those insights are, well, arguably more important now than ever.
I'd agree with that. Definitely.
Okay, let's unpack this then. We're delving into a book from 1958, still influencing the savviest investors. To really get it, we need to understand how Fisher fundamentally broke away from the investing wisdom of his time.
Yeah, and what's fascinating here is the stark contrast. So before Fisher, the dominant figure was Benjamin Graham.
The father of value investing.
Exactly. Graham championed value investing, focused on buying stocks below their intrinsic value. Essentially, looking for bargains, like finding a dollar bill selling for 50 cents.
Right, the classic analogy.
But Fisher, he came along and pioneered growth investing. This was a pretty revolutionary idea back then.
How so?
Well, it was about buying outstanding companies, ones that had the ability to grow consistently for decades, potentially.
Yeah.
For him, it wasn't about cheapness.
Okay.
It was about unparalleled quality and, crucially, significant future potential.
So not just a good deal, he was after a great business.
Precisely.
And that leads us straight to his core philosophy: buy companies, not stocks. Now that sounds kind of intuitive today, maybe.
Maybe now, yeah.
But back then, why was making that distinction so critical? What does that truly mean in practice, for someone trying to look beyond just a ticker symbol?
It means a total mindset shift, from being a trader, thinking about prices, to being an owner, thinking about the business itself.
Okay, like you actually own a piece of it.
Exactly. You need to look deeply into how a company operates, its culture of innovation, its competitive standing, how it treats its stakeholders, customers, employees, everyone.
Right.
And this isn't just like an academic exercise reading financial reports. Fisher firmly believed the biggest long-term gains don't come from buying cheap, average companies.
No bargain hunting necessarily.
No, they come from owning high-quality businesses with strong, durable growth potential. He famously said that a single great company held for years can outperform dozens of mediocre ones.
Wow.
The emphasis was totally on the qualitative stuff, the often unseen things that truly drive long-term value.
That makes perfect sense. So if he was looking for these exceptional businesses, it wasn't just a vague idea. He actually laid out a concrete framework.
He did. Very concrete.
His famous 15 points to look for in a common stock, right? That's really the heart of the book.
Absolutely the core, yes.
Can you walk us through maybe a few of the most critical ones, the ones that really show his thinking and, I don't know, perhaps still surprise people today?
Yeah, absolutely. And these 15 points were just groundbreaking because they forced investors to look beyond the simple balance sheets and income statements.
Beyond the numbers.
Totally. Let's touch on a few. So Fisher wasn't just interested in the current products. He asked, does the company have products or services with enough market potential for long-term sales growth? Emphasis on long-term.
Future-focused.
Very. And he also crucially emphasized having a strong research and development R&D program to create future growth. Now think about it. 1958.
Yeah.
Most investors weren't really scrutinizing R&D pipelines back then.
Probably not, no.
But Fisher saw it as the engine of future profitability, a continuous commitment to innovation.
That's insightful. What else stands out?
Another vital point was, does the company possess a durable competitive advantage over its rivals? We call that a moat. today, right?
Right, the economic moat.
He wanted to know what makes this company uniquely resilient. Is it a powerful brand? Proprietary tech? Something competitors just can't easily copy?
Okay, makes sense.
And maybe, most profoundly, Fisher asked, does the company demonstrate integrity and transparency in dealing with shareholders?
Ah, integrity. That comes up again.
Yes. This was a direct challenge to how things were often done then. Management prioritizing themselves, maybe withholding information.
Right.
He wanted management that was honest, communicative, and truly aligned with long-term shareholder value, not just their own short-term gain.
That last point, especially about integrity, it really ties back to that idea of buying a company, not just a stock ticker.
Exactly. You're partnering with these people.
But assessing these deeper things, R&D culture, that true competitive advantage, management integrity, you can't just get that from a quarterly report, can you?
No way. Absolutely not.
So this is where his ingenious scuttlebutt method comes in. What exactly did he mean by that? And how radical was that for an investor in the 1950s?
Oh, it was incredibly radical. So scuttlebutt, as Fisher introduced it, was basically a method to gather firsthand qualitative info about a company before investing.
First-hand info.
Yeah. He encouraged investors to act almost like investigative journalists. Instead of just relying on the official reports or news articles, he urged investors to actively talk to people. Talk to suppliers, find out if the company's a good customer. Talk to customers, gauge their satisfaction.
Makes sense.
Talk to competitors, see how they really viewed the company, and even talk to former employees.
Really? Former employee?
Yeah. To get insights into management, the company culture, things you'd never find in a report.
Yeah.
It was about getting the real, unvarnished story from people on the ground.
Wow.
Revealing insights that numbers alone simply can't. It was revolutionary for the time when analysis was almost purely quantitative.
That sounds incredibly powerful. But, gotta say, it also sounds like a lot of work.
It is work, no doubt about it. Deep research takes effort.
So let's say you've done all this diligent scuttlebutt, you found one of these outstanding companies, it checks those fundamental boxes. When do you actually buy? And maybe even more importantly, when do you sell?
Right. Well, Fisher's advice on buying was surprisingly straightforward. If you find a company that truly meets his high 15-point standards, and it has that strong long-term growth potential, you buy it.
Just like that, regardless of the market.
Pretty much. Regardless of short-term market conditions. He firmly believed that trying to time the market is far less important and often, frankly, detrimental
Right.
than simply choosing the right company. Get the company right, the timing is secondary.
That raises a really important question, though. If you've put in all that work, found this incredible business, do you ever sell? Is it really a buy and hold forever philosophy?
Mostly, yeah, but with caveats. Fisher had very specific, quite limited reasons to sell.
Such as?
Well, you should consider selling if you discover the company no longer meets his high standards. For instance, if the management fundamentally weakens,
Okay.
or its culture of innovation declines, or maybe its core growth potential shrinks significantly.
Yeah.
That future outlook changing.
So if the fundamental story breaks down.
Exactly. Or, and this is important, if you realize you made a fundamental mistake in your initial analysis, got to be honest with yourself.
Okay. Admit the error.
Right. Otherwise, Fisher strongly advocated holding great stocks indefinitely. Let the powerful effect of compounding do its work over decades.
The magic of compounding.
Absolutely. He believed the biggest wealth comes from owning outstanding businesses for decades. Frequent trading, chasing trends, that usually leads to mediocre results, in his view. It's really a testament to patience and conviction.
It really sounds like he was profoundly anti-short-term thinking, which runs so counter to a lot of the noise, the rapid-fire trading we hear about today.
Completely counter, yeah.
And another counterintuitive idea he had was about diversification. I mean, we're always told, diversify, diversify.
So at your risk.
Right. But Fisher had a different take, didn't he?
He certainly did. Fisher believed that over-diversification actually dilutes returns.
Dilutes them. How?
Well, his argument was basically that it suggests a lack of conviction or maybe just insufficient deep research. Instead of holding dozens of average companies, many of which you don't truly understand deeply, it's far better to own a focused portfolio of excellent businesses, the ones you've thoroughly researched using, say, Scuttlebutt.
So focus your bets on your best ideas.
Pretty much. For him, it was always quality over quantity. If you've done your homework, identified truly exceptional companies with strong notes, great management, Why dilute their potential by holding a bunch of mediocre ones alongside them?
Makes sense, but sounds riskier too.
He acknowledged the risk, of course,
Hmm.
but he put his faith in deep analysis, mitigating that risk, knowing your company's inside out.
And underpinning all of this, it really, really sounds like the quality of leadership was just paramount for Fisher. He put management right at the forefront.
Absolutely critical.
Oh, yeah.
Fisher emphasized that management quality is as important as if, maybe even more important than, the financial results themselves.
More important than the numbers.
In the long run, potentially yes. Great management, in his view, is innovative, ethical, adaptable, and relentlessly focused on that long-term growth.
Okay.
Conversely, he warned that poor or dishonest management, they can destroy even a really promising business.
Right.
Seen that happen.
So this focus on the human element, the brains, the integrity behind the operation, that was a key differentiator in his approach, and something he felt you could only truly assess through methods like scuttlebutt.
Okay, so pulling it all together,
Yeah.
what does this mean when we look at the landscape of investing today? How did Fisher's growth investing philosophy blend with or stand apart from the value investing that came before him? And what's its lasting legacy?
Yeah, connecting it to the bigger picture, Fisher's approach was a really pivotal shift. Unlike Graham's deep value strategy, which, sometimes involved buying those cigar butt stocks.
Right, the ones with one last puff of value.
Exactly. Just because they were so cheap, they had some remaining assets. Fisher wasn't doing that. He focused on buying high-quality growth companies, ideally at reasonable prices, sure, but always prioritizing the quality over just getting a bargain basement price.
Quality first.
Quality first. And this distinct perspective, it heavily influenced even the most famous investor of our time, Warren Buffett.
Ah, Buffett.
Yeah.
Of course. Yeah. Buffett famously later combined Graham's value principles don't overpay with Fisher's growth philosophy by wonderful businesses,
The best of both worlds.
creating that powerful hybrid strategy. The one often summarized as buying wonderful businesses at fair prices. A lot of that wonderful business part comes directly from Fisher's influence.
So ultimately, Fisher's common stocks and uncommon profits really teaches that true investing success isn't about chasing bargains or timing trends.
Not at all.
It's about finding those truly exceptional companies, strong growth potential, trustworthy management, durable competitive advantages,
All the things we talked about.
and then holding them patiently for the long run. It truly shifted investing towards a business owner mindset, didn't it?
Absolutely. Where buying a stock means buying into the future of a great company, not just, speculating on where the price might go next week.
Right. As we wrap up this deep dive into Philip Fisher's really profound insights, it's worth remembering his core message. True investing success is built on patience, quality, and a deep understanding of the businesses you choose to own.
Patience and quality. Key takeaways.
It's about thinking like an owner, not just a trader.
Yes.
So for you listening, what stands out as the most powerful lesson from Fisher? Perhaps it's that radical scuttlebutt method or his relentless focus on management integrity.
Or maybe the holding indefinitely part.
Or, yeah, that simple yet profound advice to hold great companies indefinitely. Something to think about.
Definitely.
And consider this. How might Fisher's principles, looking beyond just the surface metrics to understand the true quality, the potential, the management of an entity, how might that apply to decisions you make far beyond just financial investments?
Interesting question.
What does quality over quantity mean in other areas of your life or work? And what hidden scuttlebutt insights might you uncover if you started asking deeper questions in other domains?
Food for thought.
Definitely. Thank you for joining us on this deep dive into the world of Philip Fisher. We hope this exploration has given you a useful shortcut to being well informed and maybe inspire you to look deeper into whatever fascinates you.